welcome to Hilltop Wealth Advisors Economic and Market Update for the first quarter of 2024. I'm Ben Yeager here today with David Wise. Happy New Year, everybody.
Happy New Year.
2024 is here, and David, it's already shaping up to be an exciting year.
Ben, yes, it is. As with all New Year's come New Year's resolutions, and 2024 is no different. Hilltop's 2024 resolution is to communicate more frequently with our clients. That's you. And we actually just sent out a mailed letter to our clients talking about 2023. So I'm going to riff off of that letter as we recap last year to get us started. But keep in mind, there's going to be more letters to come. We hope you find them insightful, encouraging, and occasionally entertaining, of course. So when we look back to 2023, we can't discount the heaviness of some of the conflicts abroad in Gaza, Ukraine, Sudan, or the lost soldiers from the news we just heard a few days ago. It's certainly been a rough stretch and heavy on all of our hearts, but I think most importantly, as we move forward, we got to center our focus on what we can control, especially in these more volatile times. That's going to be essential. So there's a lot that happened in 2023. We had a regional banking crisis, new temperature records were set all around the globe. The use of AI exploded and turned multiple industries on their heads. We had Chinese spy balloons, the deep sea submarines, and geopolitical conflicts grabbing the news headlines. But in some ways, the most notable occurrence of 2023 is actually what did not happen. We never entered that recession that they had talked about. And the fear of the recession was so widespread, it seemed almost inevitable. Instead, the economy grew above 2% consistently, was much more resilient than anticipated. And the Federal Reserve interest rate peaked over 5%. Inflation retreated down to a more neutralized 3.1%. Unemployment remained resilient, and stocks and bonds both ended up positively year by year end. So bonds were up about 5%, a little over 5%, stocks up over 20%. And a lot of that tailwind was coming from the rally out of the comments that the Federal Reserve had that suggested that we are at the end of this interest rate hike cycle, and we might be in for a pause followed by potential cuts. So Ben, 2023 was very eventful. What can we expect moving forward into 2024?
Well, yeah, I think there are several big themes as we look at 2024. I mean, the big one I'm going to start off with is just economic growth. We've had very strong growth, especially towards the end of last year. We do expect that to slow down to a more modest pace globally, but unlikely to be recessionary on the whole. Somewhere around 2% GDP growth is expected for the United States. And mostly that is because we expect that consumer spending is starting to slow down a little bit. And the reason for that is debt levels have crept up over the last couple of years, and credit usage has definitely increased. Not to overly elevated levels, but started to increase. And in addition to all of that, interest rates are quite restrictive at this point. So we expect consumers to start to pull back a little bit on their spending. Now, what that will also do is to help the Fed reach their goal for 2% inflation in
Okay.
2024. And that will help with the interest rate expectations, as you mentioned before, there at the end of 2023. The Fed is now forecasting 3 rate cuts by the end of the year, and bond markets have expected as many as 6 rate cuts by the end of the year. Fed Chair Jerome Powell yesterday just tried to temper expectations a little bit with the most recent press conference and bring them more in line with their dot plot of 3 cuts this year. Unless
Okay.
the economy falters, it looks like rate cuts probably are not likely until June at the earliest.
Mhm.
Now, that is really going to help bonds and has already been a lift for bond values here the last few months. It's important to remember, though, that while the Fed has not cut rates yet, most CDs and bonds and long-term fixed income investments, they trade daily based off of interest rate expectations, not
Yeah.
necessarily on the Fed funds rate itself. So with Fed funds still very high, bonds can still do well, mostly off of the changes in expectations. And historically, bond prices have outperformed cash and the large by a large margin over the Fed once the Fed reaches peak inflation and peak in interest rates. So after some difficult years, fixed income is poised to do quite well,
Mm,
and so we're excited about that. The other side of the coin, though, is the U.S. stock market. As you mentioned, AI stocks, really the Magnificent Seven: Apple, Microsoft, Alphabet, Meta, Tesla, Amazon, and Nvidia. They dominated the headlines and contributed to
yeah,
much of the gains in the S&P 500. Their growth also pushed the S&P 500 above its historic fair value metrics. However, if we look outside those seven stocks, valuations are really quite reasonable. And we're seeing asset classes like small cap, value stocks that are trading well below their long term averages. The advancements in technology and AI could lead to some significant growth in our economy and in our markets. But it's important to remember that this growth is likely to expand beyond the seven companies that are in the Magnificent Seven and really bring opportunities to many different sectors of the market.
yeah,
Now, other areas like international stocks, we're seeing trade at below their historic fair values as well. The UK has been a little bit more sluggish growth pattern lately, but seeing some pretty significant discounts. Japan is actually breaking out of their 30-year economic slump. And we're seeing some pretty interesting opportunities there as well. China has continued to struggle, but there are other areas outside of inside emerging markets that present opportunities. For instance, India is the fourth largest stock market in the world and are home to many great companies overall. Now, I haven't mentioned probably the big one that most people are thinking about as far as events for 2024, and that is the presidential election. This is a very important event for our country, and we certainly encourage everyone to get involved and vote. When we look back at the election years, historically, we've seen some additional volatility, particularly during the first few months of the year, during the primaries when there's more uncertainty around who the candidates are. However, as that uncertainty tends to wane, markets tend to improve. And as we look at the year on a whole, stock markets tend to do pretty well during election years as well. So, regardless of which party is in office or not. So, with all that being said, a lot of interesting things occurring. How is Hilltop positioning our clients for 2024, David?
yeah. I think we can sum it up in really one word. Our approach is balance. We're trying to find a nice balance. We don't want to dial up risk too much right now, but we also don't want to be too conservative and dial risk down. So we want to lean into some of the areas where we think there's some opportunities. You know, you talked about some areas being undervalued, but not take too much of the risk at the same time. And small cap is one of the bright spots. We feel like valuations are fairly attractive, and most of returns last year coming from those larger companies, more tech heavy, AI driven. If we can get a broader recovery in stocks this year, small caps could outperform and close that gap. When it comes to alternatives and international and emerging market, valuations remain strong over the long term. And what we like is consistent income and the fact that we can get some more a defensive tilt out of that area of the market. When we move over to the fixed income side of the portfolio, we really believe in strong credit quality, decent yields, and a neutral duration at this point in time. As you mentioned, we're super excited about fixed income for the first time in a very long time, and we're leaning both into quality and a neutral duration, not getting too far along the maturity or yield curve. And so we're trying to find that nice space, that nice balance to take advantage of higher rates, but also clip a nice coupon at the same time. And I think the emphasis moving forward, most importantly, is preparation and planning over prediction and emotions. Good example of that was last year in 2023. Most of the economists, as I mentioned, believed that recession was inevitable, but the economy proved otherwise, and the markets rallied. And what happened really allowed folks to stay on task and on plane for their financial plan. And if you were out of the market last year, you really missed out. So we preach staying disciplined and long term, and I think that'll be really key as we head into this election year.
Well, thank you, David. And thank you all for watching. We really hope you've enjoyed this and learned something new. Our mission at Hilltop is to help you live the life of your dreams, make wise decisions with confidence, and better the world around you. If you're not already working with Hilltop, please know that we would love to help you too. Simply scan the QR code on the screen, go to hilltopwealthadvisors.com and click on Get Started. If you are already a Hilltop client, we thank you very, very much. We truly appreciate the relationship. Please don't keep us a secret. Feel free to share this video and our contact information with your friends, your family, and your coworkers. Thank you all.
Thank you. Till next time.